Hi everyone, welcome back to our webinar series for young investors. Welcome back to everyone who was here for the last session, and we've also got lots of new people, so welcome to all of you as well. My name is Rachel Winter. I'm one of the investment managers here at Killik, and that simply means that my job is to help other people to invest their own money. And then here with me today, I've got Tim Bennett, who's our head of education, and he's also the editor of the Killik magazine. And then behind the scenes, same as last time, we've got my colleague George, and he's going to be running the chat. So if you have any questions throughout the webinar, just pop a question in the chat and George will come back to you during the webinar, or if not, we'll do our best to answer any questions that you have at the end. So let's move on. For anyone who wasn't here last time, I'm just going to show you the agenda for the next 4 sessions. So this is a total of 5 webinar sessions. In the first one, we gave you a brief introduction about some basics of the stock market, and then we gave you some homework, and that homework was to go away and have a think about your own investment ideas. And that could have been themes to invest in, it could have been simple things like digital payments, more online shopping, or it could have been actual companies to invest in. And I have to say, we were absolutely blown away by the responses that we had. We had so many people coming back to us, and the responses were all of such a high quality. There were so many really good ideas, and we really did enjoy reading them together. So thank you so much to everyone that responded. So in today's session, we're going to be having a look at some of those ideas, and then we're going to vote on the ideas that we would like to put in our virtual portfolio. And then over the coming sessions, we'll just be monitoring that portfolio together, and Tim and I can help you to learn why certain stocks are moving in a particular way. So on the screen here, we've got what you've got to look forward to over the next few sessions. But before we have a look at the stocks that you all kindly sent in to us, I'm just going to run through a few things that have happened in the market since our last session, which was 2 weeks ago. So here we've got a chart showing what the market's done over the last 12 months. This chart is what we call indexed, so it's just showing the percentage return in the market over the last year. In the pink, we've got the S&P 500, that's the American stock market, and then in the green, we've got the FTSE 100, and that is the UK market. So you can see just under 12 months ago, we had that big crash that happened when lockdown started. Both markets have recovered quite well since then, but particularly the American market. And the reason for that is that there are lots of technology companies over in the US which have actually benefited from the lockdown that's happened over the last few months. But in the last 2 weeks since our last session, hasn't really been a huge amount of movement. You can see a tiny wobble there in the pink line, which is the American market, and that's due to a couple of things. One is the situation with GameStop, which Tim will give you a bit more detail on a bit later on. And then we've also got that sort of conflicting with the new Biden administration, and people really are quite positive about the beginning of Biden's presidency. So you've got a bit of a conflict there. People are worried about the GameStop situation, but happy about Biden. So that has caused a little bit of a wobble in the market over the last couple of weeks. Also, we've had the publication of what we call UK retail sales. So as investment managers, there are lots of bits of data that we follow on a regular basis. And one of those is retail sales. And that's simply the amount of money that people are spending on a monthly basis. So the latest publication came out just last week. And I want to show you how this data looks over the last 20 years, because it does show quite an interesting trend. So the black line in the middle, the black dashed line, that is the overall percentage change in retail sales from year to year. And you can see that that is fairly constant, but you can see that over the last year, while we've all been in lockdown, people have been spending a lot less. But what's particularly interesting is the breakdown of the different components of what's going into these retail sales. So the green line is the amount that people have been spending on clothes. And you can see that's absolutely fallen off a cliff over the last year. No one's going out, no one's allowed to do anything. Therefore, the amount that we've been spending on clothes has really, really declined. However, if you look at the blue line, that's the amount of sales taking place online. And you can see that over the last few years, that's really, really started to grow. And that's something that we talked about last session. But over the last year, it's just absolutely spiked. So lockdown's been bad for clothes, but very good for general online sales. And then we also had some great data on renewable energy. So this data shows how electricity is generated across the 27 EU member states. And something really exciting happened over the last week. And that was some data that showed that for the first time in history, Europe generated more electricity from renewable sources than it did from fossil fuels. So on this chart here, you can clearly see the trend. We've got renewables in the green and we've got fossil fuels in the pink. And you can clearly see there is a significant rise in the growth of renewable power. So that's a very positive piece of news there. And then finally, a piece of news that a lot of you might have read about over the last couple of weeks. We have had a bit of a situation with a company called GameStop. So I've got the chart here showing the share price over the last year. And you can see that for most of the last year, it's been plodding along at about $4. But over the last month, it's spiked up to $350 and then it's fallen back down. And so I'm going to bring in Tim now, and he's going to give you a bit more information, firstly about how share trading works in general, and then he's going to use that to explain exactly what's happened with GameStop.
Well, thank you very much, Rachel. Yes, delighted to be back again for my short section highlighting what was going on last week, and it was quite a week. I'm going to use a few props as we go along to help me out, so bear with me on that one. I have young children and I have borrowed a few things that they normally own to make my point, cover a few technical points as we go. So, share trading. What are the various ways you could buy and sell shares? Well, one of them is through digital apps. There's one out there called Robinhood, and that one came to the forefront last week. So what have you got? Essentially, the key players in what happened at the end of last week are small retail investors represented by this fluffy toy. And then you've got the hedge fund sharks, if you like, and small retail investors taking on sharks individually, not a good idea. That's not a match. Come back to what they're actually doing in a moment. So you need lots of them, okay? So basically, how do you get lots and lots of retail investors together, and a few pros as well hidden in there amongst the sort of innocent looking fluffy toys? Well, the answer is basically you organize them through bulletin boards, subreddits as they're known. Reddit's a big one. Wall Street Bets is a subreddit. What you do basically, to cut to the chase for those people wondering what I'm talking about, is you get a chat room on the internet together through one of these sites. There are potentially 7 million account holders available. Now, that is a decent number of people. And if you can organize them, rally them all to buy a small group of stocks, let's say GameStop in particular, if you can get them to buy that simultaneously, you are going to have enough power potentially in the market to move the price upwards. Now, why are you trying to do that? Well, quite simply, a lot of people thought buy low, sell high. So you buy a stock, buying pressure moves it up, you sell for a higher price, make some money. But my goodness me, the end of last week, GameStop went up by something like 1,600% in a very, very short space of time. That's a massive rise. So objective number one, make some money. Objective number two, take out some of these sharks. Now, how do you do that? Come back to that in a moment. And objective number three, if you like, is to sort of punch the nose of Wall Street. There are people out there who don't like the way that Wall Street operates and wanted to kind of show that retail investors have some power. And then you've got people who can be corralled behind these bulletin boards because, frankly, they've been in lockdown. They're a bit bored. They haven't spent much money. They'd normally take a punt on sports matches, cajoled into basically joining this retail army. So on the one side, three key players. On the one side, you've got hundreds of thousands of account holders potentially organized through one bulletin board, one app, ready to go. They can trade quickly and cheaply, okay? On the other side, you have the hedge funds represented by the fluffy killer whale. Now, why do you want to target these hedge funds, you might ask? Because what these funds do is something that sounds a bit unusual. They look to target companies that they think are doing badly, that are financially weak, and they look to make money from falling share prices. So you've got people trying to come in to make money from a rising price by literally driving the price up against these hedge funds who do things called short sales. Now, to save myself a bit of time here, this is a description of a short sale. So this is the whale, the killer whale. Imagine you've got hedge funds who think GameStop is a weak company, the financials are not strong, it's going nowhere, let's try and make some money out of betting on falling prices. How would you do that? Well, in a nutshell, a short sale is you borrow shares in the company you're targeting. These are the killer whales. You then sell them on in the open market. you wait, hoping the price will fall as you expect, and then you buy them back. So think about it, you've sold before buying, but if you sell high and buy back low, you'll make money. Make up some numbers, the sale is at $2, the buyback is at $1, you've got $1, then you need to return them to the original lender. Who is that lender? Potentially an institution, could be a pension fund. Why were they happy to lend stock to the killer whale hedge fund manager in the first place? Well, because as a pension fund, you sit on loads of stock. Why not earn a bit of interest from a hedge fund for loaning it out short term? So there's the scenario. Now, how do you catch out a hedge fund in that situation? Well, the answer is between stages 2 and 3. If the hedge fund basically is waiting for the share price to fall on GameStop and it doesn't, it starts rocketing. Why? Because in come this retail army through the Robinhood app driving the price up, then they got a problem. They've still got to buy back the stock and return it. Otherwise, you've got one big pension fund manager that's going to be seriously upset. You're in breach of contract. So now they've got to find the stock, but horror of horrors, it's not dropping, it's actually rising. Worse than that, if you're a hedge fund with a big short position, you go into the market looking for stock that's rising, you're going to drive it up even further, because to close a short sale, you need to be buying stock. So you've got a double whammy effect here. You've got this retail army, okay, driving the stock price up, and you've got hedge funds now, the whales, panicking and also driving the stock price up, trying to get to stage 4 where they can return the stock they've borrowed. It's called a bear squeeze or a short squeeze, because the price is rocketing, and what's more, there might not be a lot of stock around for you to actually get your hands on. So there's the scenario, all right? And essentially what happened, quite a few high profile hedge funds lost money, all right? And a lot of investors who got their timing right, which is notoriously difficult to do, will have made some money on the kind of Robinhood side of the equation, all right? Now, something else happened, and this is where I want to come to some conclusions about this whole thing. Something else happened that was unusual last Friday, which was that Robinhood was faced with such a big army of buyers that at one point they actually had to suspend trading on their platform, their app, in the very stocks that these people are trying to make money from. And that upset a lot of people. Now, why is that? I did say there'd be a bit of technical stuff here. So I'm just going to reverse this board for a moment, all right, and put it this way around. So the reason is, for those people wondering, because the trading suspension is still being investigated. There are people suing Robinhood because they claim it was outrageous that trading was halted. It bought the hedge funds time, is the accusation. But actually what happened was, if you imagine the Robinhood app in the middle is trying to match buyers and sellers, right? It's a trading platform. So you can put a sell instruction, click of a button, buy instruction, all right? And basically, if you imagine, if you've got enough trades going through that app in one direction, essentially the app will get a phone call at some point from the central clearinghouse called the DTCC in America. And what they do is they try and they help to maintain a stable market. And a stable market means that if somebody agrees to buy shares, they will pay for them. And if someone agrees to sell shares, they will deliver them. Because otherwise the market would be chaos. You'd have people making promises they can't keep. So the DTCC margin people like Robinhood. They say, well, if you're going to basically in 2 working days time, which is what the market behind the scenes, the plumbing works on, if in 2 working days time, you're saying all this cash will arrive in the right bank accounts, all the right stock will get delivered to the right place at the right time. If you're going to underpin all these trades basically in the retail market, you need to collateralize them. You need a security deposit with us. And the volume of trading was such, it magnified so quickly that essentially the phone call came in from the central clearer to Robinhood saying you need to find more collateral to back these positions, all right? Otherwise, we don't think potentially you're capable of making sure all these trades get honoured. So Robinhood suddenly then had to go around cap in hand looking for money that it needed to put on deposit effectively at the central clearer in order to be able to promise that all these trades would actually be followed through, if that makes sense. They would clear and settle, as it's called in stock market terminology. And Sounds a bit weird, but it's a convention, old creaky systems, if you like. Some would argue that behind the scenes, when you trade, it takes 2 working days normally for the stock to actually move from seller to buyer, legally, if you like, and the cash to go in the other direction. And in the middle, there's a risk. Things can go wrong. Clearing in the middle, settlement at the end. So where are we now? What's the outcome of all of this, and what do you take away from it as an investor, let's say? And I'm trying to use this as a way of explaining how the market works. So where are we now? The retail army, for the last time, that's this lot, moved on. All right, they moved on to silver. Now that is a very, very tricky market to try and play as a novice. Aside from the fact you're a novice, playing the commodities market, as the Hunt brothers discovered back in the 1980s, Google them if you're not sure, trying to corner the silver market is a pretty dangerous thing to do. Because frankly, you don't know, for example, how much supply there is. If the price goes high enough, people might start going into their kitchen cupboards, melting down silver things and flogging them. All right. So there are lots of reasons why the silver market is quite difficult to predict. It is used in lots of different ways: industrial, jewelry, and for pure speculation. So anyway, after GameStop share price sort of started collapsing, if you like, so the bubble popped, the retail army moved on to silver, but that hasn't worked out too well either. And in the wake of all this activity, what do we got? We've got essentially legal cases being brought against Robinhood for, as some people see it, suspending trading. You know, outrageous. Didn't that buy time for the sharks to recover? Well, no, some of the sharks did lose money. Some of them made money. On the buying side behind this lot were some of the sharks. One hedge fund made $700 million US is estimated by being on this side, not that side. So it just goes to show. The SEC are looking at it. That's the regulator in the US. What they're looking at is whether there's any evidence of insider trading using information that nobody in the market has. It's sort of unfair. It's not a level playing field. Probably no evidence of that. Market abuse, market manipulation, possibly, but then they'd have to look at both sides of the transaction. So I'm not going to try and call that one. The SEC are doing an investigation. Lessons: an awful lot of investors who went in too late will have lost a lot of money. And you don't tend to hear about those stories in the pub. You tend to hear about the ones who made money, not the ones who lost it. Okay. So the motto, I think, and I'll hand back to Rachel in a moment and I'll be back for questions at the end. The sort of takeaways are, from an investment point of view, single stock investing, having a punt on a meme stock, which has no financial stability, doesn't look like a good bet, but people are just buying it anyway. That's dangerous. All right, that's why we run diversified portfolios. Lesson number one. Lesson number two, trying to time the stock market is horrendously difficult. Everyone thinks they're going to buy low and sell high. Of course they do. But the greater fool theory says there's usually someone out there who is basically quicker and more knowledgeable than you are about what's going on in the market. In other words, you can fall prey to the sharks, basically. And there was a shark behind the kind of Reddit attack on the markets, as it turned out last week, a whale, as they're known in market speak. And so timing the markets is a bad idea. And the third thing is, I personally only believe in buying things you know something about. A lot of people do bandwagon trading, and that's dangerous. They hear, oh, GameStop, I'll jump in there. Now, fine, if you've got money to lose, if that money would have gone on a horse racing bet, which I'm not recommending, by the way, but if it's money that you just want to have a bit of a punt with, have some fun with, and you can afford to lose all of it, well, maybe. But as an investment proposition, these so-called meme stocks have proven themselves to be a little bit dangerous. And as to wandering into the commodities market and buying things like silver, well, that's a whole nother story, but I wouldn't necessarily go there either. So that's it from me. That's enough fluffy toys and whiteboards, I think. I'll hand back to Rachel.
Thanks, Tim. I like the fluffy toys. Okay. So now we're going to have a look at putting together our virtual portfolio. So what I'm going to do is I'm going to talk you through 20 of the ideas that you guys have sent to me. Some of you guys sent me kind of general themes like electric vehicles. So what I've tried to do there is pick out stocks that are relevant to that theme. And some of you have sent me specific companies. So we're going to go through a mix of 20 of the different ideas that you guys have sent. And I'm going to get you guys to vote. And what you're going to do is you're going to pick your top 8. So we're going to go with 8 of your ideas. And then later on, I'm going to have a look at the 8 that you've picked, and I'm going to add in 4 of my own. And the reason I want to do that is I want to make sure that our portfolio, as Tim said, is quite diversified. So if you guys pick 8 stocks and there's, for example, no healthcare exposure in there, then I'm going to go and add in a healthcare stock. So what we're going to do is run through 20 stocks and you're going to pick 8. But before I do that, I just want to make the point that sometimes, in fact, quite often, you'll come up with a really, really good investment idea and you just cannot find an investment on the stock exchange that gives you exposure to that idea. And we did have a few examples of that coming in as the homework that you guys sent in. And so I just want to run through a couple of those examples because I did think there were such good ideas, and we did try and find companies on the stock exchange that related to them, but we just couldn't find any. So the first one is space travel. Lots of talk about this at the moment. We all know that Elon Musk is running a company called SpaceX, but at the moment it's not on the stock exchange, so we can't invest. And at the moment, there aren't really any other companies that are involved in space travel, but it is an area that people are very excited about. And hopefully one day there will be a company on the stock exchange that we can invest in. Another one is kennels. So we talked in the last session about loads of people getting lonely in lockdown and lots of people buying dogs. So dogs basically sold out over the last year. But this year, when lockdown lifts, it's very likely that people are going to want to go on holiday, they want to go away for a few days, and they'll need someone to look after their new pet. So I do expect that this year there will be lots of demand for kennels, but at the moment there aren't really any big animal shelters on the stock exchange. But again, it's a really good idea, and it is something that we will keep an eye on. And then the final one is North Face. I'm sure lots of us are familiar with that particular brand. Really good idea. I know that in lockdown, going for a walk is pretty much the only thing that we're allowed to do. There has been a lot more demand for walking clothing, and I know that North Face has done very well, but unfortunately at the moment the company is not on the stock exchange. And so I just wanted to make the point that often you'll have really, really good ideas that aren't investable at that particular time. But let's move on and let's go through 20 of the companies that you guys sent to me. So I tried to break them down into different categories. So the first one was electric vehicles. It's highly likely that 10 years in the future, we'll all be driving electric vehicles around. So we've tried to pick some companies that will benefit from this particular theme. The first one is NIO. So a couple of you suggested NIO and a couple of you suggested Tesla as well, but we've gone for NIO. And this is essentially China's answer to Tesla. It's a Chinese company that manufactures electric vehicles, and the reviews of these vehicles so far have been very strong. So NIO is a company that we could potentially put in our virtual portfolio. The next one is a mining company called ANTO. And the reason we've suggested this one is that in a regular car, you need to use 25 grams of copper. But in an electric car, you need to use 75 grams. So if you believe that everyone's going to convert from petrol cars to electric cars, surely that means there'll be a big increase in demand for copper, and therefore the copper price will go up. So for that reason, if you believe in electric vehicles, you might want to invest in a copper company called ANTO. Next theme. This one still relates to electric vehicles. Rather than investing directly into the cars, you could invest in the companies that are making the batteries. So lithium batteries are expected to be used in electric vehicles. And there is a company in China called Ganfeng Lithium, which is currently mining for lithium and also manufacturing these batteries. And so you can see by this map here that in the green, they've got lots of different lithium mining sites around the world. And in the red, they've also got various battery manufacturing facilities. So again, if you believe in electric vehicles, you could consider investing in this battery technology company. A lot of you actually talked about hydrogen, which I was super impressed by because this is really quite a futuristic theme. And so hydrogen is expected to be one of the clean fuels of the future. But at the moment, there aren't many ways to invest in it, but we have got a couple of options. One is a company called Air Products and Chemicals. And this is really an industrial gas company. So it provides gas to lots of factories who need them for various industrial processes. And the company has started to get involved with hydrogen. It's involved in it in 3 different ways. One is something called gasification, and that is converting other materials, for example, biomass, into gas, including hydrogen. So that is potentially a very promising source of hydrogen in the future. Another one is something called carbon capture. So at the moment, we're worried about the amount of carbon dioxide in the air. If we could capture that and make it back into a solid material, perhaps, then that would be very good for the environment. And then finally, we've got hydrogen for mobility. So essentially using hydrogen as a fuel for cars and other vehicles. So this company, Air Products and Chemicals, is involved in hydrogen and other clean gases in a variety of different ways. So that is a company that we could potentially add to the portfolio. And another one is Toyota, which you may well have heard of. It's one of the biggest car companies in the world, but Toyota is probably the most advanced in terms of all the other car companies, in terms of developing hydrogen fuel cells. So using hydrogen as a way of generating electricity in order to power a car. So if you believe in hydrogen, and if you believe that hydrogen will be powering vehicles in the future, then perhaps Toyota is a company that you might want to put into our virtual portfolio. Lots of you talked about renewable power as well. And when we looked at the start of this webinar at the growth in renewable power that we've seen across Europe, I think that shows that renewable power will continue to grow over the next few years. So ways to get exposure to that theme. One would be to invest in companies that are developing wind farms. So we had quite a few ideas here. Some of you mentioned Northland Power, some of you mentioned Ørsted. So we've gone for Ørsted, which is a Danish company, and it develops wind farms all around the world, both onshore and offshore. So we've got a picture here of an offshore wind farm. And the amount of technology that goes into producing these is absolutely incredible. I mean, lots of these wind turbines are bigger than the Eiffel Tower. So they really are quite difficult to build. And Ørsted is one of the global leaders. So that's wind power. You could also consider looking at solar power. So someone has recommended SunPower Corporation, which is a company that is involved in manufacturing solar panels. We've then got the theme of health and fitness. So people are becoming more concerned with their health and their fitness. And particularly during lockdown, we have seen lots of people trying to improve their fitness with home workouts. So how could we invest in that particular theme? Health-wise, we could have a look at Beyond Meat. Lots of people are trying to improve their health by reducing the amount of meat that they eat. And Beyond Meat is a company that is producing a lot of plant-based alternatives. It's done very well, it's grown very quickly, and it's just entered into quite a big deal with McDonald's to produce a plant-based burger. Next one is Lululemon. Predominantly a clothing company, so known for its yoga trousers. Yoga has become very popular in recent years, and people have been buying lots of yoga wear and loungewear during lockdown. But the company has started to move into fitness equipment. So they have developed something called the Lululemon Workout Mirror, which is almost like a sort of, I suppose, like a massive TV screen that shows you workouts that you can do. And so that's how the company is transitioning towards becoming a technology company as well. And then we've also got Peloton, an electric bike company that streams spin classes that you can do. These bikes are £2,000 each, but they have sold so many during lockdown. Apparently it's quite addictive. I don't have one myself, but I'd love to get one. But it's a company that I know is doing incredibly well. Lockdown lifting. So a lot of you came up with ideas for companies that have done very badly in the last year that might stand to do well when lockdown finally starts to ease. So a couple of examples are International Consolidated Airlines, which is a company that owns British Airways. They've had a very difficult year, but if people do start to go on holiday again this year, then perhaps their share price will start to recover. Another one is Anheuser-Busch InBev. So a couple of you mentioned breweries and different beer companies. Obviously, because pubs and restaurants have been closed, a lower amount of beer has been sold over the last year. But if lockdown starts to lift and people are allowed to go out again, then perhaps beer sales will pick up once more. So Anheuser-Busch is the biggest beer company in the world, and it owns Budweiser, which is the most popular beer in the world. Lots of you talked about gaming. Someone mentioned Twitch, which is a platform where you can watch other people playing video games. I've never done it myself, but I understand it's incredibly popular. Twitch is actually owned by Amazon. So if you wanted to get exposure to Twitch, we could invest in Amazon. Xbox, a couple of you mentioned Xbox. That is actually owned by Microsoft. EA Games, developer of the FIFA game franchise, as well as a number of other games as well. GameStop. I thought because we've talked about it today, I wondered if a couple of you might like to follow the story. I'm not saying this is a great company to invest in, but this is a virtual portfolio and it's not intended to do well. It's intended to help us learn about the stock market. So if you wanted to follow the GameStop story over the next few weeks, then we could pop that one into the portfolio as well. Then we've also got some technology companies. Someone mentioned Docusign. So clearly historically, when people wanted to open an account or sign a form for something, you had to get a lot of paper involved. But now that everything's moving online, we can sign things digitally using Docusign. So this is a company that has done really well in lockdown, and we believe it will continue to do well. Someone mentioned takeaways, and in particular, this person mentioned the packaging that is being used for takeaways and food deliveries. And unfortunately, we couldn't find a company that's specifically focused on that type of packaging, but we have suggested that we could put Just Eat into the virtual portfolio. And Just Eat is another company that's done incredibly well during lockdown. Alphabet, we did a poll last week where I asked you, I gave you a list of 5 apps, and I said to you, if you could only use one of these apps for the next month, which one would you choose? And lots of you said YouTube. And that is owned by Alphabet, which is the company that also owns Google. So if you want to invest in YouTube, we could get you some Alphabet shares. Snap. Snap was another app that you said you couldn't live without for a month. So we've also got the option to invest in Snap shares. So that is the end of the list. So that is 20 different companies that we could potentially invest in. So what I'm going to do now, I'm going to stop sharing the screen, and I'm going to show you a poll. So what I want you to do is to pick your 8 favorite companies. Unfortunately, due to a limitation on Zoom, we cannot have a question with 20 possible answers. You can only have 10 possible answers. So what we've had to do is split this into 2 questions with 10 stocks in each one. So you'll need to look at both of the questions and then pick 4 questions from each. So we're going to start the poll now. You need to pick 8 of your favorite companies, split into 2 lots of 4. So let me launch the poll. And I will give you a couple of minutes to have a look through and pick your favorite ones. I'm actually so excited to see what you're all going to put. I can see about half of you have finished your voting, so we'll give it a couple of more minutes. Okay, I've got just a couple of people who haven't voted, so I'll give you another 30 seconds and then we'll finish this. Okay, I'm going to finish it there. Brilliant. Thanks, everyone. So what we'll do after this, we will send down the full list of what everyone voted for, and then we can help you to set up the portfolio on the virtual platform. I'll show you the results. Hopefully you can see them on the screen, but NEO was incredibly popular, as was Antofagasta, the copper company. Ørsted, the wind farm company, that was very popular, as was Beyond Meat. Peloton did well. IAG actually did incredibly well. That's the British Airways company. The beer company was a strong contender as well. Amazon as well, owner of Twitch, and also Alphabet. So really good selection there. So I will send you around the full list after this webinar has finished. What I would like to show you now is how we're going to be monitoring the virtual portfolio. So we've got two different platforms that we're going to use. I couldn't find an app that I was happy with that would allow us to monitor the portfolio. There are a few apps that do allow you to set up a virtual portfolio. A lot of them aren't particularly good. A lot of them don't allow you to buy American stocks, and a lot of them just pop up with adverts all the time trying to get you to buy Bitcoin. And I think my compliance team would shoot me if I recommended one of those. So I haven't chosen any of those apps. What I would suggest is that you download Yahoo Finance. I use this all the time. I think the financial data on there is really, really good. So in the first box here, you can see the full name of the app. You cannot set up a portfolio on here, but you can monitor a list of stocks. So you can't invest a sort of fake amount of money and see how it grows, but you can follow a list of stocks. So if you search for a stock, and then when you find it, you just click on the star button in the top right-hand corner. That will add the stock to your list. And then you can monitor what the price of that stock does. And you can also sign up to receive news alerts on that particular stock. So if you want an app where you can follow the stocks, I think Yahoo is a really good option. What I would also suggest is Morningstar. They don't have an app, but the desktop virtual portfolio thing is really, really good. So I'm quickly going to show you how to do it on here, but I will send around instructions afterwards showing you how to set up the virtual portfolio on Morningstar. So it's morningstar.co.uk, it's not .com. So you set up an account, you click on portfolio here. You would then click on create portfolio, and you can give your portfolio a name. There's two types of portfolio. One is a watch list, which is simply just a list of stocks. We want something called a transaction portfolio, which will allow you to invest an imaginary amount of money into a certain selection of stocks and to monitor that over time. If you want to add a stock to this portfolio, you type in the name of the stock. Bear in mind that some stocks are listed on lots of different stock exchanges. So what I will do, I'll make it really clear which stock you want to be buying. You can then put whether you're buying or selling. And what's really good, you can put how many shares you want to buy. You can put the date at which you would like to pretend that you bought the stock, and you can put the price. And this is really good because I can tell you exactly what I'm putting, and you can do the same thing. And then we'll all be monitoring exactly the same portfolio. So I think for that reason, I think this platform will work really well for us. And what you can also do, you can set up an alert and you can ask it to send you a daily or a weekly email with a summary of exactly how the portfolio has done. And it will have loads of different stats kind of comparing our portfolio to the market. And so I think this is a really, really good virtual tool. But don't worry about doing anything now. After this is over, I will send you an email with instructions on how to set this up and a full list of the stocks that we have chosen to go into it. So we've got 5 or 10 minutes left before we finish. So I'm going to stop it there. I'll stop sharing that slideshow. And we've got a few minutes to answer any questions that you have. So I can see that we've got a few that have come in already. First one, could meme stocks and cryptocurrencies such as Dogecoin, which has been constantly backed by high-profile people like Elon Musk, prove a major danger in the stock market, as many investors do not know what they're getting themselves into? My answer to that would be yes. I think that when you're buying a stock in a company, you can analyze that company and you can decide how much you think a share should be worth. With a cryptocurrency coin, how do you work out how much you think it should be worth? I just don't think there is a possible way. And for that reason, you do see a huge amount of volatility in some of these cryptocurrencies, and therefore I would consider them to be a very risky investment. Tim, I don't know if you have anything else to add to that.
Yes, I mean, obviously, high-profile people like Elon Musk have gone in behind Bitcoin. If you want my view, what's really interesting and is the future, is the technology that underpins things like Bitcoin, which is called blockchain, but that has many, many uses way beyond virtual currencies. The virtual currencies themselves, I wouldn't have a clue how to price them. With a stock, I've got some way of doing that. And frankly, understanding the mechanism behind the market, it is pretty tough. Who are the big buyers? Who are the big sellers? Who's really behind it? Liquidity is a problem. What you can actually buy and sell with it is a problem. So at the moment, it's one for the brave, I think, rather than one for the fundamentals. What worries me a bit, actually, to answer the question that was asked there about sort of GameStop, is if a lot of retail investors are piling into the market, I think what the last week has shown is they can't move the market by themselves, even in big numbers, for long, without the help of some of these sharks. And one of the big hedge funds was behind the buy side, if you like, and made the 700 million or whatever it was. So the worry's got to be that if people are relying on trading stocks, cryptocurrencies, to actually make money they need, that would be a bit of a worry, because that will have ramifications, both if individual stocks crash and if the wider market takes a hit, which it does from time to time. So then we'd be into the kind of shoeshine boy signal, as it's called, when the shoeshine boy is giving you stock tips, things might be going awry. So I would say if people are actually using this as a vehicle to make money, cryptocurrencies, single stocks, meme stocks, then we've got a problem.
Next question, why would a stock be listed on multiple different stock exchanges at the same time, and are the prices all tied to each other? Usually it's because people want trading in that stock to be available around the clock. So let's take HSBC, for example, which is a bank that's based in London, but it has very, very strong ties to Asia. So HSBC shares are traded in both London and Hong Kong because they appeal to investors in both of those markets, and they want the shares to be available to be traded all around the clock rather than just in London hours. And yes, the prices should be very, very similar between the two exchanges. Otherwise, everyone would be buying on one exchange and selling on the other. Let's see. Two quite similar questions here. So one is there anything wrong with trading 212, a trading platform? And the second is, what's your opinion on day trading? I'm not going to say there's anything intrinsically wrong with it, but I do think it is quite risky. Trading 212, I think it is an easy platform to use. It's a good way to learn how to invest, but I do think it encourages very frequent trading, and it almost makes the stock market seem a little bit like a game. So I think there is a bit of a risk there. With day trading in particular, I personally view that as quite similar to gambling. I believe in long-term investing. I don't think it's very easy to predict the price of a share from day to day. There are just so many factors involved, but I think it is quite straightforward to pick a company that you think is going to do well over the next 10 years and to buy those shares and hold them for the long term. So at Killik, we are very biased towards long-term investing, and we do believe that's a much less risky way to get a very good long-term return. Here's one for Tim. What do you think Jeff Bezos stepping down will do to the Amazon stock price?
Oh, sort of a million or billion dollar or even $1 trillion question.
$1 trillion question, yeah.
Yeah. The answer is hopefully not very much, in the sense that a bit like people asked the same question around the time that Apple changed hands in terms of CEO, if you like, Tim Cook's arrival. The bottom line is, I think that Jeff Bezos will hopefully have stepped away from something that he's very passionate about, something that he loves, leaving firm foundations for the future in terms of product innovation and in terms of sort of market share ambitions. So I don't know how you feel about that, Rachel, but I don't think Amazon's under any immediate threat from Jeff Bezos stepping away. And he's only stepping away. He's not stepping completely off the platform, as it were. Yeah, absolutely. I think that's the key point, that he's not leaving. He's still going to be very much involved. So I'm not worried about it. But I think that is a valid question for other companies. We have got a number of massive tech companies now, like Amazon, like Facebook as well, that are still managed by their founder. So the question is, should we be worried about what happens when those founders do step away? So it is a real consideration. Absolutely. Next question. Investing in overseas stocks brings foreign exchange exposure. How should we manage and think about that risk? I'd actually say you've always got foreign exchange risk, even if you're just investing in a UK company. So if you look at something like
BP, Shell, even HSBC that we mentioned, the vast majority of their revenue is made overseas. So even if the stock is listed in the UK, you've still got that foreign exchange risk, because if sterling rises and HSBC is making money in dollars, it has to convert those dollars back to sterling to report its profits. And if sterling is higher, it's going to make HSBC look less profitable. So I would say if you're investing in any company that's either doing business overseas or buying its raw inputs overseas, there is going to be some currency risk. So it's very difficult to avoid currency risk. So I think all you can do is make sure that you have exposure to lots of different currencies in your portfolio, and the movements, hopefully over the longer term, will net each other out. So invest based on what companies you think are good, rather than according to a particular currency and where you expect it to go. Let's see, probably got time for just one more. Can you see the questions, Tim? I don't know if you want to pick one that you would particularly like to answer. Pick an easy one.
There's a cracker, but and it's going to sort of be, I'll use it to sell one of my future sessions. How do you know if a stock is cheap or expensive? Massive question. Obviously, that's the key to long-term investing. You want to buy good companies at a competitive price, ideally. What I'll say to that is there are lots of ways of doing it potentially, and I'll be hoping to cover a few of them in my What Do Equity Analysts Do session a bit further down the line.
Great. And we'll look at that in our portfolio as well. So we'll look at different ways of valuing the stocks that we are going to virtually invest in. Brilliant. Well, it's almost 10 to 6, so we're going to leave it there. But thank you so much to everyone for joining again. Great to see so many people coming back. And thank you again for sending so many great ideas. It was just great to see how involved you got and how you'd really thought about the ideas. So thank you very much. And we look forward to seeing you at the next session.